Okay guys, I'm back for episode 23 of the Quintuple M, the Monday Mr. Money Mustache Motivation. This episode comes from the blog post from May 18th, 2011, How to Make Money in the Stock Market. So this blog post is all about investing, and that's an important topic, so I hope you stay tuned to the end. This blog post is a little bit longer than some of the others I've done, but it's an important topic, and we'll throw in some discussion as well. So we'll jump right in. How to make money in the stock market. I must admit my title for this article sounds scandalous and scammy, like something a Las Vegas-based email spam company would send out, but it's also completely accurate because I really can teach you the best way to make money from the stock market all in one short blog post. Some of our readers are already advanced investors. Those few people already know all of this, and the article will just be preaching to the choir. But the reason I'm still writing is that almost nobody I meet in day-to-day life knows anything about investing, the stock market, or big publicly traded companies in general. Their opinions on the subject range throughout boredom, fear, mistrust, and if they're lucky, curiosity. Or if they're unlucky, bold confidence in their abilities to drastically beat the market with their intuition. I have found that to be true in my own life. Most people don't know how investing works, much less the stock market, and I was one of those people. I still don't claim to know everything. I am by no means a financial planner, a financial advisor of any sort, so all of this blog post is Mr. Money Mustache's opinion, and my discussion is just my opinion. Y'all take that for what you will. But yeah, I was one of those curious people who are lucky, I guess, because I've learned a little bit about investing, and while I don't claim to know it all, I know that I don't know enough to know everything, but now I do know at least the basics and enough to feel comfortable to begin investing once I get to that point in my journey. I, still have debt that I'm working on right now, but when I get the debt gone, then I'm going to be okay to go ahead and start investing. Here are 3 real quotes I've heard from friends over time when discussing the stock market. Stocks are just a big roulette wheel. You can't go out swimming with those sharks on Wall Street. They'll just eat you up. I don't know what my retirement money is in. I just checked some boxes on the sheet when I started my job, but I don't really understand it. I've been guilty of that on more than one occasion. I don't really believe in mutual funds at all. I'm dedicated enough to do my own research, and I can pick winning individual stocks. I've got some Apple, some Google, some crude oil, gold, pig's feet, whatever. All 3 of these approaches are understandable, but wrong. The sentiments are valid, and I'm glad that people at least have an opinion, but each represents a lack of knowledge about the statistics that run the whole system. Knowing the nature of the market is the key to being able to invest huge sums of your money over time with the absolute confidence that you're not doing anything stupid. It's worth gaining this confidence because investing knowledgeably in stocks has always been the single best thing to do with your money in terms of getting lifetime income with absolutely no effort on your part. And that right there is the big draw for me when it comes to reaching financial independence. A lot of people like to go the real estate route because there's larger returns and faster gains if it's done correctly. But it also requires more work, and that's not an income that is truly passive unless maybe you hire property managers to handle your property, but even still, you have to deal with the property manager. So yeah, and investing is something that I plan on doing to reach financial independence, and that way the income I have will truly be passive. To start with the basics, what is a stock? It's a slice of a company that you truly own. When you own a share, you have the right, but not obligation, to attend the shareholders meeting for that company, vote on important company decisions, and you have the right to a share of any future earnings that the company makes. This share of earnings is called a dividend. In some companies, especially smaller or younger ones, the company elects, with the permission of its shareholders, to reinvest the dividends to help the company grow its earnings even faster. In theory, this means you will get more dividends in the future. Thus, the real value behind any share in a company is the right to get a never-ending stream of dividends from it. For example, the old, long profitable company, Lockheed Martin, currently pays a 3.8% annual dividend while growing slowly, while Apple Computer, fancying itself a high-growth company, pays 0% right now and reinvests all profits for faster growth. Why do stocks go up and down so much? The true value of a stock is based on the amount of dividends this stock will eventually pay you, the shareholder, over time. That dividend depends entirely on how much money the company will make. But nobody actually knows in advance how much money companies will make. They just have a big host of differing opinions. Every day, millions of investors and analysts scurry around and worry about how much money each company will make in the future. The Libyan people are revolting. This will make the world have a shortage of oil, so prices will go up. Oil companies are now worth more. Buy. The U.S. economy is slowing down. This means people will drive less to the shopping mall and buy less gas. Oil demand will go down and oil companies will make less. Sell. It's a never-ending din like this for every single stock on every single stock exchange throughout the world. If stocks are so crazy, how can I make money off of them? Because in the long run, it turns out that all of this speculation and volatility always cancels out to absolutely zero. The value of stocks will go up as the earnings of the underlying companies go up. A portion of the ongoing earnings will always flow to the shareholders as dividends. And all this happens because of the natural ingenuity and hardworking humans making things at a profit and continuing to advance our knowledge and technology and make us all more productive in every field. There may come a time when we no longer can advance, but based on the fact that we're still driving around in gas-burning tanks and Home Depot is still doing all of its computer on green-on-black mainframe computers that kick you back to the beginning of the order if you make a typing mistake, I'd say we have at least a lifetime left to go in this department. That's true. Have you ever bought anything at Lowe's lately? So, stocks go up and pay dividends over time, and they have since the beginning of modern commerce. The total return has averaged a very lumpy but fairly dependable 10% per year before inflation, 7% after inflation. 5 of the 7% comes in the form of rising stock prices, and the other 2 comes from dividend payments directly from the company to you. When you're in your stashing stage, you just let these dividends automatically reinvest in more stocks, which creates a nice compounding effect. But which stocks do I want to buy to make this free money? This is the easy part. You buy all of them. The world's smartest people have done incredible studies on this for over 40 years. What they find is that the best way to make money in the stock market is to simply buy an index fund, which is a mutual fund that automatically buys appropriate ratios of every major stock in your country's stock market with no magic and guessing of which stocks are better than others. The reason the index fund wins statistically is because it can be run by a simple, automated set of rules. No need to pay $350 million salaries to the hotshot traders running the aggressive growth fund down the street, because there are millions of people, both smart and dumb, squabbling over the value of each stock. The index fund benefits and suffers from all of the individual stock performances, but overall, you get the average performance of all of the squabbling, the 7% mentioned earlier. If you descend into the pit and try some squabbling yourself, you may come out ahead or drastically behind the average, but as it turns out, you can't predict in advance which squabblers, including yourself, will win and which will lose. All you can predict is that your average performance, if you buy enough of these funds, will be equal to the return of the market as a whole, minus the amount of fees your mutual fund charges. So by picking the index fund with the lowest fees, you automatically win. Endless statistical analysis proves this again and again. If you don't believe me, read the book, A Random Walk Down Wall Street, or look up the topic of John Bogle / Bogleheads and the founder of the Vanguard company itself. But my uncle bought some stocks once and sold it at a big profit. Also, if index funds are statistically the best, why are there still thousands of brand name mutual funds and hotshot traders out there? for the same reason that Las Vegas exists and people are still driving SUVs. Humans are irrational creatures, and it's scientifically proven that we overestimate our own investment and gambling abilities. And no presentation of knowledge to the affected people can completely erase this. I have some perfectly intelligent friends who still believe that they are lucky at games of chance, even though any scientist in the world can quickly run an experiment to irrefutably disprove the existence of any form of luck. The only tool you can truly use is statistical probability, and by buying the market average and lowering your investment costs, you are improving your statistical chances. Okay, fine. What index fund do I want? There is one king index fund that makes the decision easy for you. The Vanguard Total Stock Market Index Exchange Traded Fund, VTI. It tracks the entire U.S. stock market index. Its expense ratio is 0.04%. Kudos to you if you knew that that's what I was referencing on my thumbnail photo. This means that for every $100,000 of shares you hold, they subtract $40 per year from their gains to pay for their offices and trading costs. Some funds charge 10 to 20 times higher fees. So if you are looking over employer-sponsored plans, try to find a total stock index fund, or at least its close cousin, the S&P 500 index fund, and compare the expense ratio to 0.04%. So, as I was slowly gaining knowledge about investing, as I was learning more about achieving financial independence, when I realized that I now had enough knowledge to feel comfortable choosing what funds I wanted to invest in for my retirement account at work, I decided to look into that. Previously, I had always chosen a target date fund, and I had chosen to have my portfolio managed by someone else because I just didn't know enough and was a little bit fearful about choosing the wrong thing. So I let somebody else handle it. But, you know, having gained a little bit of knowledge, thankfully I've learned that investing really does not have to be very complicated. So as I was learning more about investing, I decided one day to take a look at my 403b retirement account at work. And lo and behold, we actually did have some Vanguard funds that I could choose to invest in. And the one that I chose was the Vanguard 500 Index Fund, VFIAX. And I am really lucky that I had that to choose. And I put 95% of my retirement account in that, and the expense ratio is 0.04%. And the other place that I chose to invest the remaining 5% was in the Vanguard Total Bond Index Fund. So I have 95% of my retirement account in stocks, and the other 5% is in bonds right now. The expense ratio on the bonds is 0.05%, also really excellent. And yes, my portfolio is very heavily weighted in stocks right now, but I am not anywhere near retirement at the moment, so I'm okay with that. I'll change it later on down the road as I get closer to retirement. What is the S&P 500? This is a collection of shares in the 500 largest companies in the U.S. and therefore in most of the world. They are all multinational companies, so they benefit from growth around the world. If you really want to invest without having to worry, the S&P represents good odds. If you buy the stock market index of a smaller country like Canada, you will still have good odds, but at higher volatility. During the dot-com boom of the 90s, a company called Nortel once represented 70% of Canada's entire stock market value. This company is now bankrupt, so you can imagine how that felt to investors solely in the Canadian index. Now Canada is the new Saudi Arabia with oil exports, so its index is again riding high on oil company stocks. I wouldn't bet my whole mustache on that one commodity either. What about international stocks? Some people like to get fancy and buy international index funds, which can do well when the U.S. is hurting, as it has been recently. This is fine as long as you understand that it's just another form of trying to outsmart the basic stock index. When you do this, you're stating that you believe the stock markets of other countries are more undervalued relative to future growth than the U.S. stock market is. The U.S. is traditionally the most business-friendly country in the world, so its stock index has tended to have the highest performance after taking into account its lower risk and volatility compared to, say, throwing all your chips onto Russia or China. It may or may not pay off in the future. I just want to point out that most people just make this decision on a whim, something like, China is so hot right now, they're taking over the world. Whereas to actually justify international investing rationally, you'd have to be a very sophisticated investor and truly understand why you are going to do it. So there you have it in 2 words, Vanguard.com and VTI. So yeah, this was a really excellent and informative article by Mr. Money Mustache. As always, I will link this below so you can read the whole blog post and all of the comments on this if you want to. This really helped break it down for me and make it, a little bit more basic and understandable for me as someone who really is not investing anywhere except for my retirement account at work right now. But between this and the other things that I've learned through listening to podcasts and reading different blogs, I feel a lot more comfortable now than I used to about investing. One thing you will notice whenever you get into this financial independence world, there are a couple of books that keep coming up over and over and over for people to read to learn about investing on a basic level. One of them was mentioned in this blog post, the Boglehead's Guide to Investing. I will link it and the other book, J.L. Collins, The Simple Path to Wealth. Both of those books keep coming up over and over about the basics of investing and index investing specifically. Now, me personally, I have not read them yet, but they are at the top of my list. Those will be the first 2 books that I read once I get prepared to actually start investing more and investing in something other than my retirement account at work. So yes, I highly recommend them because other people I trust have also highly recommended those books, and I'll link those below as well if you haven't read them yet. And just wanting to add to Mr. Money Mustache's part about what about international stocks. He kind of mentions it in the blog post, but if you're buying an index fund, and I know J.L. Collins does talk about this in his book as well. If you're buying a total stock market index fund or even the S&P 500, the top 500 companies in the U.S., that in its very nature makes you invested internationally because those large companies are already international companies. So, if you choose to do something else international, that's up to you. But just know that you already technically have sort of an international part of your portfolio by investing in these larger companies that are US based. So, yes, takeaways from this blog post. Investing does not have to be complicated. As a matter of fact, it's a lot less complicated than I ever thought that it could be. And choose index funds and definitely pay attention to your expense ratios. And lastly, expect the average return over the long run. That is why whenever I'm trying to calculate the true cost of something now, I use the 7% compounding because that has been what the stock market has returned on average. So whenever I take into consideration the cost of something now, instead of just what the price on the thing is, I take a look at, well, what if I had taken that amount of money and invested it in the market over, say, 10 years? Then how much money would I have? And then I try to decide whether it's really worth it or not to get that thing. So, and yes, I did want to touch a little bit more about expense ratios. They are very important when it comes to choosing where to invest. However, it's not the only thing to consider. A lot of people do focus on that heavily, and that's cool, but just be aware that it's not the only thing to focus on. I myself, through listening to other podcasts and things, like I say, I have just a very basic knowledge of investing right now. I know that Mr. Money Mustache as well, in some of his later blog posts, he recommends Betterment along with Vanguard. And for me, someone who's not completely comfortable with investing, right now, I am leaning towards using Betterment over Vanguard. They do have some other things that they offer along with, you know, their investment services. They have a 0.25% expense ratio, which is higher than 0.04, yes, but they do things for you automatically like tax loss harvesting. And that is something that I am not at all familiar with how to do myself. I know that you can do it through Vanguard with your own investments if you know how, but there's rules around how to do it, and I don't know enough to feel comfortable doing that myself. So I think that as your portfolio grows, tax loss harvesting can become something that is very beneficial for you. And I don't think that's ever something that I'll be comfortable doing myself. So as of right now, that's why I think I'm going to go with Betterment once I get to the point of investing heavily. I could still change my mind and end up going with Vanguard. Yes, the expense ratios are way less with Vanguard, but I'd be curious to know, if you are a Vanguard investor watching this, do you take advantage of tax loss harvesting, and how do you do it? Comment below and let the rest of us know, because that's something that's a little intimidating for me. And also, to illustrate the importance of expense ratios, actually JJ Buckner, he just recently did a video on his channel. I will link it below. It's a video about 10 frugal habits. I'll have the title of it below in the description box, and like 10 different ways to save money. And the last way he mentioned on that video is about paying attention to your expense ratios. And he's got a really good example on there of what a difference the expense ratios can make. You know, it may not sound like a lot going from 0.04% to say a 1% expense ratio, but it makes a huge, huge difference in the long run. I also will link below a article that I read by NerdWallet that discusses expense ratios a little bit more than what Mr. Money Mustache did here. And I'm going to read just a small excerpt from that NerdWallet article that really helps illustrate the importance of paying attention to your expense ratios. The impact of fees is twofold. An investor pays an ever-increasing amount in fees as account balances grow, because the fees are based on a percentage of the assets, and fees also strike a blow to the portfolio's returns. That's because every dollar taken out to cover management costs is one less dollar left to invest in the portfolio to compound and grow. So in addition to paying potentially hundreds of thousands of dollars in avoidable fees, our research shows that an investor gives up many times that amount in lost portfolio returns over time. So opportunity cost of having to pay these fees. To examine the effect of fees on a millennial investor, we looked at different investing scenarios for a 25-year-old who has $25,000 in a retirement account, adds $10,000 to the account every year, earns a 7% average annual return, and plans to retire in 40 years. In one of the scenarios analyzed, paying just 1% in fees would cost a millennial more than $590,000 in fees. And then they go on to say that if you choose a lower expense ratio, through the magic of compounding, you can retire nearly $533,000 richer by choosing the one with fees that are 0.93% or lower. That's 0.93%. And Vanguard is 0.04%. That's pretty darn low. By assembling a low-cost exchange-traded fund, or ETF, portfolio on his own and rebalancing it once a year, a millennial can retire $345,000 richer than if he uses a target date mutual fund. And that's what I had always invested in before, just a target date fund, because didn't know any better. Outsourcing portfolio management to a robo-advisor could be a less work-intensive alternative to self-managing and less costly than a target date mutual fund. In our scenario, using a robo-advisor would cost $232,000 in fees over 40 years, about half of the $454,000 a target date mutual fund would cost. So yes, I mean, no matter what the expense ratio is, you're going to lose some money to fees. The important thing is to try to minimize that loss as much as you can. And I am looking at the robo-advisor, using Betterment. And is it as cheap as Vanguard? No, but it's not the worst option. And like I say, they do have some other features, the automatic tax loss harvesting, which I think might be a good thing for me in the long run. So yeah, if you are at the point in your financial independence journey where you're investing heavily, let me know down below, what do you like to invest in? Are you big into real estate? Are you an index investor? Do you pick your own stocks? Are you a dividend investor? That's something that I really enjoy about this financial independence community. There are any number of ways available to you to build wealth. And however you choose to do it is however you decide is the best way for you. There's not a one-shoe-fits-all type system. And I think that's a good thing, because everybody can take away bits and pieces from other people's journey and improve their own financial journey and maybe reach financial independence faster and learn from what other people are doing. So yeah, comment below. Let me know how you're investing in your financial independence journey. And this video is really super long, so I may have to break it up into 2 sections. We'll see. If you're still here at the end of this one, thanks for watching all the way through. Like I say, investing is an important topic, so it's important to learn as much as you can. If you're new here, feel free to subscribe to this channel. I'm always posting about financially related topics, whether it's saving money or investing, preparing for retirement, whatever the case may be. So subscribe if you haven't already. Thank you for watching, and I will see y'all in my next video. Bye.